Are you thinking about buying a multi-unit property? Need a few tips? Wondering what goes into that process and what all this means to you? All that and more, and quickly, because this step-by-step, ooh baby, investing talk is making me hungry. Please, if you like the content, send some Swedish fish. Stay tuned. This is Vasilios and you're watching Fastlane. If this is your first time on this channel and you want to get the latest actionable tips from a local realtor that will actually save you time, save you money, and result in a smooth real estate deal, then give us a like, hit the subscription button below, and smack the bell icon so you don't miss any content. Now, onto it. This is a step-by-step guide on how to purchase a multi-unit property. Now, each transaction is a little different depending on the specifics and its details, but these steps are a great blueprint to help you gain your confidence and to analyze and take action into your investing path. Step 1, research. Now, when it comes to the research of a multi-unit or multifamily property, there are quite a few steps involved. The main factors that you need to research are: where are you going to buy this property? Do you know exactly what you're going to buy? Do you have a property in mind? Have you done your research on the neighborhood? You need to dive in and analyze your actual investment. So to start out, you need to research the current market in that location that you're buying, and also research the actual process of buying a property and investing. You can do this by going on YouTube and watching videos like this on this channel, or going on to some expert sites like Bigger Pockets as an example. This will get you started and get all the juices flowing. Step 2, quick analysis. Next up, what you want to do is a quick analysis on the property in question. What you want to do is some quick math. Jot down some numbers on a napkin and see if it actually makes sense. See if the numbers are actually working in your favor. What is the income, the rental income, and take an average of common expenses. See if you're positive cash flow, and what is your target for cash flow anyways. This is a great time to determine what you want and need for cash flow to start, or are you more concerned about the increase in equity over time and can deal with a little cash flow in the beginning. This research process is basically a pre-screening to see if the property fits what you're trying to do with it. So first step is to find yourself a property investment calculator. You can find on several websites. I'll reference Bigger Pockets in this case, or if you have a good idea of what is entailed in a property analysis or a balance sheet, then you should already have a list of income and expenses that'll get you quick to knowing if this is a good deal or a bad deal without really diving in head first and getting into the nitty-gritty just yet. Your next step in what you're going to need to do is figure out how you're going to actually purchase this property. How are you going to buy it? Where are you going to get your funds from? So now you need to figure out how you're going to pay for it and how much you'll have to put down for a down payment. Will you need 20%? Will you need 30% down payment? Do you have enough cash to purchase the entire property? Another option would be is a hard money lender. A lot of your research will go into this process, as it should. You should research every avenue to gain you the most and best options available to you. Also, when you get to this point, if you're looking at a 40-unit or less, it's considered a residential loan. If you're financing, if you're looking at a 5-unit or more, you're getting into a business or commercial loan. Rates and conditions will change and apply to each respectively. So as well as speaking to a lender or other investor, whichever way you decide to go, this will require a lot of your research and time and needs to be spent in this section of the process. Now, once your finances are essentially figured out and you have a really good idea of where you're going, the following process kind of goes in line with any purchase. Your offer gets accepted, earnest money is put down, you get your inspector or contractor in there to take a look and get you some more numbers and some more finite details as to what it may need. After your inspection, you have a really great idea at any major problems, if any, in the property or home itself. Next up, an in-depth analysis. Now, generally, once you've already figured out your financing, you will get to the point where you really need to dig deep and you really need to dive in and do an in-depth analysis. At this stage, what you need to do is look at every single number and see if it truly makes sense, and what your dollars and cents will be truly at the end of the month or at the end of the year, depending on how you want this investment to go. At this point, you really need an investment calculator of sorts. You need to check out your utility bills, what the heating bill specifically is, what the water bill specifically is, what your estimated taxes will be for the following year. Really dive in and get as close to a definitive number as you can. At this point in the process, you need to account for vacancy, maintenance, capex repairs, and we'll call them all the big boy expenses for investing. Now, when you get to this point, you really want to make sure you run all your numbers and double check them twice. You want to run them through as many investment calculators as you can to ensure your dollars and cents will add up at the end of the month. A few important terms and calculations you really need to dive into are your NOI, net operating income, your cap rate. You need to know what the actual cash flow is. With whatever property you decide to invest in, location is key. And with location, you need to find an area with high growth potential that will also have high yields, which will also increase your demand. Higher demand can mean increase in your rental income. Finding a property that was well maintained is icing on the cake. It'll save you a lot of headaches in the future. For a few of the best and most detailed calculations that you will need, check out this video at the card at the top of your screen. Disregard the shoddy video. The content is pretty useful, however. At this point in the process, you need to know what you're getting into and exactly how much money you need to get this done with. So what you need to do is put together a proposal. You can call this a business plan. And you take this business plan and you present it to a bank or a lender or an investor or a hard money lender, whatever you're deciding to use. Your proposal will be reviewed at this time, and if you are using a lender, you'll be going through the underwriting process. And fingers crossed you can get that through to the other side and be successful and arrive at the closing date. Now at this point, you actually close on the property. You're at the end of the transaction. What you need to do now is figure out if you will need to hire a property manager, do it yourself, or hire an assistant. Whichever direction you go, you need to stick to your business plan that you had created. Run it like a business because, well, it is. So you probably should. Account for the unexpected. Having a buffer in your expenses is always a smart way to ensure you're staying in the black and are producing your hard-earned equity and cash flow. Now, if you like this video, then check out these at the top of your screen. And if you need a guy like me, I have a guy like me's info in the description below. And as always, thank you for watching. I'll see you in the next one.